네, 시청자 여러분 안녕하세요. 한경 글로벌 마켓 김종학 뉴욕 특파원입니다. 직격 인터뷰 월가에서 듣는다. 오늘 순서는 화폐 전쟁 그리고 한국어판 금의 미래로 유명한 제임스 리카즈를 모셨습니다. 최근에 금값이 사상 최고가 행진에 거듭하고 있는 그런 배경에 있어서 가장 정확한 식견을 제공해 줄 만한 분으로 오늘 자리를 함께 할 예정이고요. 시티와 롱텀 캐피털에서 고위직을 역임하면서 자본시장에 대해서도 상당히 전문적인 식견을 가지고 계십니다. 미중 간의 문제 그리고 또 달러화의 움직임을 어떻게 전망하는지 오늘 인터뷰를 통해서 샅샅이 짚어보도록 하겠습니다. First of all, it is remarkable how accurate your predictions have come true. Recently, we witnessed the price of gold futures for June reaching an all-time high on the New York Mercantile Exchange. What are your thoughts on the current factors driving this surge in gold prices?
Well, there are a number of factors, but they're all sort of pointing in the same direction. The first one, I would say that there's a lot of buying of gold by central banks from 1970 to 2010. Central banks collectively were net sellers. Beginning in 2010, they became net buyers. It's not all the same countries on both sides, but certainly China, Russia, Iran, Turkey, Philippines, Mexico, Vietnam, and others have been, Kazakhstan have all been large buyers of gold. But I would say that's accelerated because of the coming BRICS currency. They don't have one yet. They're working on it. They need to expand the membership of the BRICS. It will take several years. This isn't going to happen overnight, but Sergei Lavrov, who's the Russian foreign minister, has said that the currency will be gold. I would say gold linked. That's different than gold backed. It's not going to be the case that you'll be able to walk up to the People's Bank of China and with the brick, unit and say, "Give me some gold." But it will be gold linked, probably by weight, and so that's the reason for all the BRICS members to acquire more gold. Number two, the United States is in the process of stealing perhaps as much as $300 billion of U.S. Treasury securities that are legally owned by the Russian Federation in retaliation for the war in Ukraine. The U.S. is discussing this with its European NATO allies. They have different plans. We don't have time to go through every single plan. Some of them want to steal only the interest. Some of them want to steal the principal, which, as I say, is 300 billion. Some of them want to do a loan backed by a pledge of the bonds. Of course, the loan would default because Ukraine has no resources, and then the Russian bonds would go to the lender. So it's not clear which plan is going to come through. It's on a fast track. They probably want to do it by June or July. But if you are Korea, South Korea, or Japan, or Taiwan, or China, or Saudi Arabia, or Turkey, or any other country that has large reserves in U.S. Treasury securities, seeing the United States steal the securities from Russia would cause those central banks to think about diversifying, at least to some extent. I'm not saying they're all going to dump their U.S. treasuries, but at the margin, they'll have less interest in treasuries and more interest in gold in order to prevent theft by the United States. And then finally, there's a geopolitical concern. You look at the Suez Canal is closed. Global financial sanctions in connection with the war in Ukraine are an impediment to world trade. We had this collapse of the bridge, the Key Bridge in Baltimore, but Baltimore in the United States, one of our largest ports, that port is closed indefinitely. But because it was a highway bridge, the collapsing bridge closed the port, but the bridge itself was a highway, and now the highway is closed. So it's impeding truck traffic. So just a lot of disruptions across the board. So I think of gold, people traditionally think of it as the inflation hedge, which it is, but I'm calling it the everything hedge. In other words, it hedges against theft by the United States, geopolitical concerns, supply chain concerns, war, financial sanctions, etc.
Actually, gold prices of bronze have experienced the significant fluctuations by history. If we attribute this gold rally to factors such as inflation, as you said, the geopolitical tensions, what additional reasons do you foresee to gold to maintain its upward trajectory in the future?
Well, the other factor, in addition to the ones I mentioned, I talked about BRICS, Russia, war, geopolitical stress, etc. But another factor is just basic supply and demand. Global gold output, gold production plus scrap, which is just recycling existing gold, jewelry, etc., has been constant for about 6 years. It's not collapsing, it's not declining, but it's not going up either. Gold is increasingly hard to find, it's expensive to mine, etc. So gold output has been flat, but gold demand has been rising for the reasons we mentioned, including central bank buying. So it's just economics 101. When supply is flat and demand is rising, the price tends to go up. That's very good news for gold investors because the price could go up a lot for the geopolitical and other reasons we mentioned. But a supply demand, I won't call it imbalance, but the supply demand situation I described, flat supply, large demand, tends to put a floor under prices. So it's what I call an asymmetric trade. On the one hand, you have the upside from all the geopolitical stress. On the other hand, you have a bit of a floor because of this supply demand situation. So it's a very positive outlook for gold.
Let's continue with the next question. Since 1971, it's appeared that perception of gold as a form of currency has faded from the public consciousness. However, how do you continue to view gold as playing a pivotal role in the international monetary system and as a reliable form of currency? Is it possible?
Well, I would distinguish, at least in the short run, between gold as a monetary asset on the one hand and gold as a currency on the other. Gold is not a currency. If you have a gold coin, it's a good store of wealth. It's a good thing to have. But if you walk into a Starbucks, you won't be able to buy a cup of coffee with it. They'll kind of look at you funny, or at least it would be a very expensive cup of coffee. So gold has not regained its currency status in terms of gold coins that we would carry with us and spend. But it is a monetary asset and is a global reserve asset. And I would say you need look no further than the gold holdings of the major economies of the world. The United States has approximately 8,100 metric tons. China reports a little less than 3,000 metric tons, but there's good reason to believe that they have a lot of gold off the books in something called the State Administration of Foreign Exchange, or SAFE. So they have more gold than that. It's hard to know how much more gold, but maybe even double that they have off the books. Russia has over approximately 3,000 metric tons. Even the IMF, which doesn't talk much about gold, they have over 1,000 metric tons. Japan has about 900 metric tons, and so on. So if you look around the world, the total gold reserves of all these are sovereign gold reserves. I'm not talking about individuals, but sovereign gold reserves are about 38,000 metric tons. So why would they have all that gold if it's not a monetary asset? And the answer is it is. They just don't like to talk about it because it's not one that they can control. With central bank money printing and bank reserves, you can control that to some extent through a central bank. But people are freed in most countries, not all, but in most countries, to buy gold at market prices. So they don't really control the price of gold, but they certainly hang on to it. So that in itself suggests that there's it's a significant store of wealth and a monetary asset. Again, I would say if it's not, why would you have all that gold?
Let's delve into that issue. Could this considerable accumulation of gold potentially challenge the dominance of the US dollar?
The only way it could do that would be if you had a currency backed by gold. And there's no country in the world that has enough gold to back the currency completely with gold. That's just not the case. People talk about a gold backed yuan. That's never going to happen. I mean, China's gold reserves, they're growing, but relative to their money supply, they only have about 1.5% gold backing for the money supply. The United States is not much better. If you look at a different measure, which is gold to GDP, so take the amount of gold you have as a country at the market price, and divide it by your GDP. That's one way of thinking about if GDP is your real economy and gold is a form of money. How much money do you have relative to your gold supply? So to me, that's an important measure of strength. The gold superpowers are Russia and Switzerland. They have over about 9 or 10% of their money supply in gold. That's quite high. The other countries that are in pretty good shape are Germany and Italy, believe it or not. The United States is down around under 2%. China's around 1%. So there's no country in the world that has enough gold to back a currency with gold to make it freely convertible. Having said that, you still have to have confidence in your currency, and gold is one way to inspire that kind of confidence. And there is a way to link a currency to gold without making it fully convertible. All you have to do is say, my currency, the value of my currency is, 1 unit equals a weight of gold. And most people think of the value of currencies in relation to other currencies, which, it's fine if you're a foreign currency trader, foreign exchange trader, but and for some balance of payments purposes, but it really makes no sense because all of the central bank currencies are what's called fiat money. They're not backed by anything. And so when you compare one to the other, you don't really have an objective measure of value. You're just, as I say, comparing currencies to each other. The objective measure of value is to compare your currency to gold. So right now, people like to say, well, the dollar's going up, the dollar's strong. If you look at the DXY index, yeah, it is strong. It's 105, and the yen, Japanese yen is crashing. It's around 152. The Chinese currency is going down. It's approaching 7.3 to the dollar, et cetera. But those are just currencies compared to currencies. But when you look at the dollar compared to gold, people say gold's going up. It's, $2,100, $2,200, $2,300 to the ounce. But that's not how I think. I mean, that's true, but that's not how I think about it. I don't think gold's going up. I think the dollar is crashing because it takes more dollars to buy an ounce of gold. That means your dollars are worth less. So the dollar is only strong in relation to other currencies, but it's not strong in relation to gold. And to me, gold is more of an objective measure. In terms of backing a currency with gold, the way the BRICS are going to do it is by just defining the new unit by weight of gold. And that way you don't even need any gold. And then let the market determine the dollar price of gold, puts the dollar in the position of having to sort of do all the dirty work, so to speak. So I don't think that we'll see fully convertible gold-backed currency anytime soon, but that doesn't mean that gold does not play a role.
In March, discussions at the FOMC meetings included the possibility of reducing the balance sheet by $7.5 trillion. There is also speculation regarding the Fed potentially lowering the elevated benchmark interest rate. How do you think about that?
Well, the notion of the Fed lowering the what's called the policy rate or the target rate for Fed funds has it goes by the name pivot. In other words, they were starting in March 2022 and continuing through July 2023. So for over a year, the Fed raised interest rates very steeply. But the notion that they would cut rates is called the pivot. In other words, they would pivot from raising rates to lowering rates. Wall Street has been wrong about that for 2 years. Wall Street started talking about the pivot in the summer of 2022. They didn't think the Fed was going to cut rates soon, but they said by the end of 2022 or early 2023, they would cut rates. And then in 2023, they said they would cut them by the summer of 2023, and they didn't. Then the fall, and now here we are, 2024, and they're talking about the spring of 2024. The Fed's not going to cut rates, not anytime soon. This is just a fairy tale, or what technically called a narrative. It's a story made up by Wall Street to get people to buy stocks. The fact is the Fed raised rates through July 2023. The Fed has not cut rates. The Fed's not going to cut rates in May. Wall Street is now betting on June. My view, the Fed's not going to cut rates in June and probably not in July. The next meeting after that, there is no meeting in August. The next meeting after that is in September 2024, but that's kind of dangerously close to the U.S. presidential election. The presidential election is November 5th. And so the Fed says they're not political. They're actually highly political, but they do a good job of pretending otherwise. But the Fed does not want to cut rates in September because it looks completely political. It looks like they're trying to help the Democrats and hurt the Republicans, and the Fed doesn't want to get in the middle of that. So if we take September off the table, there is no meeting in August. That leaves May, June, and July. They're not going to cut in May. It's close to that, and they usually give out some advance warning. So you're left with June and July. The problem with June, that's the latest version of the pivot from Wall Street, is that the Fed has not won the battle of inflation. The Fed is losing the battle of inflation. Inflation is going up. It's not going down. It came down. It was 9.1% in June 2022, and it's 3.2% in the most recent data. I'm using headline CPI year over year. But 3.2% is not 2%, which is the Fed's target, and that's up from 3.1% the prior month. Now, what about the forecast for inflation? Well, all you have to do is look at oil prices. Oil prices have gone from $68 a barrel to $85 a barrel in about 2 months. That doesn't merely affect the price of gas at the pump. That's one very strong effect. But it affects the price of everything because it's used in transportation. Anything that moves on a truck or a train or a boat or a plane or something that uses gasoline or jet fuel or diesel fuel. And so the price increase in crude oil has not worked its way through the economy yet. It's starting to. We're seeing higher gas prices at the pump, but that's going to run for a couple more months, which means that your inflation is going to continue for a couple more months. Now, it's one thing to say the Fed will eventually get inflation under control, although I have some doubts about that, but it's almost impossible to see how the Fed would cut rates if inflation's going up, and inflation will be going up because oil prices have gone up about 20% in the past couple of months. And so I don't think the Fed's going to raise rates in June. July, we'll have to wait and see, but what I'm describing is not going to be fully absorbed by July. So I think the Fed's in a real dilemma. They painted themselves into a corner by leading the markets on. The markets just sort of took the ball and ran with it, but the inflation is not under control.
Now, when it comes to the interest rate, would you consider the Federal Reserve monetary policy during the recent period to have been successful or failure?
Failure. For two reasons. Number one, the reason I just mentioned, which is that inflation is not under control. And so that's the biggest failure in and of itself. The Fed also is not that important. People want to make it important. People like talking about it. They watch the meeting, and I watch them too. I watch the press conferences because it's what I write about and talk about. And so I do pay attention to it, but it just is not that important. It's more of a shell game or a magic show. They want you to think it's important, but it isn't really. The thing that is important is fiscal policy. And that explains why there are a lot of signs of recession all over the place. Inverted yield curves, negative swap spreads, job hiring is dried up, housing prices are flattening. So many, many signs of recession. And yet the U.S. economy is doing fairly well. By the way, the rest of the world's in recession. Japan, Germany, UK, EU are all in technical recessions. China's slowing down a lot. Their stimulus programs have not worked. The U.S. GDP is still going up fairly substantially, over 3% in the fourth quarter of 2023, and maybe a comparable amount in the first quarter of 2024. But that's being driven by fiscal policy, debt and deficit spending, which is non-sustainable. You can get a little growth in the short run. In other words, if you borrow money and spend it, you'll get some growth. But if the debt is going up faster than the economy, then your debt to GDP ratio is getting worse and you're heading to some kind of collapse. We're not there yet. It can go on for a while. But I don't take a lot of comfort from strong economic readings if they're driven by deficit spending, because that is non-sustainable. But none of that, the fiscal policy is important, but it has nothing to do with the Fed. The Fed deals with monetary policy, and there I would just say that they are a failure because inflation is not under control.
According to the U.S. Bureau of Economic Analysis, the last quarter of a previous year So robust growth 3.4%. The Federal Reserve has even revised its growth forecast for this year from earlier estimate 1.4% to more optimistic 2.1%. Optimistic about soft landing this year is growing. However, is there truly no risk on economic downturn looming?
There's a very large risk. First of all, you're right. Of course, you're right about the growth numbers, but as I mentioned, the growth numbers are being driven by debt and deficits. There's a very important threshold, which is well documented in economic research, particularly by Kenneth Rogoff, who's a professor at Harvard, and Carmen Reinhart, who's formerly a professor at Harvard, but also today the chief economist of the World Bank. But they've written books and a number of articles, both jointly and individually, and they've shown that they look at the debt to GDP ratio. So they say, how much debt do you have, and how large is your GDP? That's the ratio. 30%, no problem. It's a very comfortable ratio, and up to a certain level, there is a kind of a Keynesian multiplier, meaning if you borrow $1 and spend $1, you get more than $1's worth of growth. If the government borrows $1 and spends $1, you might get $1.30 or $1.25 of growth. The problem is, as the debt to GDP ratio goes up, that extra multiplier goes down. And so what is the critical threshold? What is the point at which if you borrow $1 and spend $1, you don't get $1's worth of growth, you get 90 cents or 80 cents or 70 cents. In other words, your debt is going up faster than your economy, and your debt to GDP ratio is getting worse. What is that critical threshold? Their research shows very conclusively, in my view, that it's 90%. That this is why the Maastricht Treaty, which governs the fiscal policy of the European Union, sets a threshold of 60%. It's to create a cushion between 60 and 90, but it's very clear that 90% is the level at which when you borrow $1 and spend $1, you don't get $1's worth of growth, you get something less. And by the way, the fourth quarter of 2023 in the United States was a spectacular example of this, because we had a huge deficit in the fourth quarter. The growth was strong. It was, as I say, over 3%. But the growth in the debt was even higher. It was a lot more than that. And so the ratio that I described, where you borrow $1, spend $1, how much did you get? It was only about 60 cents, 0.6 instead of 1.2. We're past the critical threshold. So the U.S. debt to GDP ratio is over 130%. And by the way, the Congressional Budget Office says it's approaching 100%. But the Congressional Budget Office is wrong. And the reason they're wrong is that they do not include debt issued by the Treasury held in certain government programs, such as the Social Security Fund. But that's nonsense. Are you not going to pay Social Security? Are you not going to pay Medicare? Are you not going to provide benefits that have been promised to U.S. taxpayers or as citizens? So the idea that you can somehow take Treasury debt, which is owned by different branches of the U.S. government, and say we don't count it because we owe it to ourselves, begs the question, well, what are you supposed to do with it? The answer is you're supposed to pay benefits, and it's politically impossible to imagine not paying the benefits. I mean, we'd have if the government didn't pay Social Security benefits or Medicare, we'd have a revolution in the United States. I can promise that. So my point being, you should count that debt. And when you do, instead of the 90 or 95% figure of the CBO, you actually get 135%, which puts the United States in the same category as Lebanon, Greece, Italy, and other notorious debtor nations. But apart from that association, when you go back to Reinhart and Rogoff, their research, once you're past 90%, you're not getting you cannot borrow your way out of a debt crisis. So the U.S. is getting some growth by large debt and deficits, but the amount of growth is slowing down. It's now growing more slowly than the amount of debt, and we're in a completely non-sustainable situation, which historically has always ended in default, restructuring, or hyperinflation. The U.S. will not have default or restructuring because we can print the money. That's true, but we're very likely to end up in a highly inflationary episode.
That means U.S. economy is not unsustainable by this situation.
Correct.
Yeah.
Correct. Same thing with Japan. It doesn't mean that your economy collapses. It does mean you have very, very low growth. Japan is a good example. Japan has had 9 recessions in the last 30 years. Now, those are 9 technical recessions. I would call it one long depression. I would describe the Japanese economy as a 30-year depression. And it's interesting that just about a month ago that the Nikkei stock index got to 40,000. Well, the first time it hit 40,000 was December 31st, 1989. In other words, it took 35 years to get back to where it was in 1989. Yeah, if you bought the bottom, you could have made money in the meantime. I understand that, but that's a long time to wait to get your money back. So I would say Japan has been in a 35-year depression, which again is not unprecedented. And there, of course, their debt to GDP ratio is closer to 300%. So again, they haven't defaulted. That's not the point. The point is it destroys growth and it's non-sustainable. And the U.S. is sort of like the new Japan. I will say that Korea is a country that seems to be doing a lot of things right. Korea is taking its debt situation seriously. They are, restraining spending. They're not, cutting spending, but they're keeping it on a sustainable path, and they have a comfortable debt to GDP ratio. So I would look at Korea as a model country that's doing things the right way.
Do you believe these debt concerns poses a substantial threat to the US dollar? As you mentioned that, do you still foresee these issues potentially leading to a currency war?
Well, it's not exactly a currency war. Currency wars are intentional. It's where a country sets out to deliberately cheapen their currency in order to promote exports. Or perhaps you want to strengthen your currency to fight inflation. You can make your currency stronger or weaker depending on what your policy objective is. So that's kind of what currency wars are. I think it's fair to say that China is in a currency war. China has struggled to maintain growth. They still have positive growth, but the Chinese figures are not reliable. I mean, they were going back years, they were a steady 10%, and then all of a sudden it was 7%, and then 6%. Now they say 5%, but they're struggling to get to 5%. And a lot of the Chinese growth, or GDP, I should say, is investment, particularly fixed assets, infrastructure, train stations, public housing, airports, et cetera. Well, I've been to China. I've been not just to, Shanghai and Beijing, but I've been out in the country. I've been to Nanjing, Chongqing, Xi'an, Wuhan, a lot of different locations. And I've also been out to these so-called ghost cities. I've seen them firsthand. They have skyscrapers and country clubs and hotels and subway stops and all kinds of buildings, and they're all empty. And then you look on the horizon, you see another one, 10 miles away, and it's also empty. So that does create jobs. It does create demand for steel, aluminum, glass, copper, cement, the other inputs, but it's wasted. If you were using generally accepted accounting principles and you spent the money on the ghost city, an accountant would say you had to write it off because it's a waste. So even the official figures, which are not reliable, even those are overstated by the amount of waste that they don't write off. So the Chinese economy is probably, in real terms, ignoring the waste, is probably not growing more than 2 or 3%. Maybe it's in recession. It's just hard to know because they can fake the numbers. But be that as it may, China has tried all these stimulus programs. They've cut interest rates. They've cut reserve requirements. The official U.S. data shows that China has been selling U.S. Treasury securities. And people say, oh, well, that proves China is trying to dump the dollar. They're trying to dump treasuries. They're trying to get out of the dollar. That's nonsense. I mean, it's quite the opposite. China wants as many dollars as they can. They're actually in a dollar shortage, part of a global dollar shortage. The reason they're selling treasuries is to get cash, dollars, that they can give to the banks to meet their obligations to customers who have dollar-denominated external debt. So it's really the opposite of what a lot of observers assume. But all of China's stimulus policies have failed. The economy is weakening dramatically. China's an export-driven economy. Well, who are the importers? Well, the importers are people like Germany, the UK, France, Italy, Canada, and others, among others, who have their own economic problems where their economies are all slowing down. And that means there's less demand for Chinese goods. It also affects Australia, which is a major exporter to China. If China's slowing, they buy fewer exports, and that causes Australia to slow. So with all that taken into account, China's trying to cheapen its currency to stimulate its economy. It won't work, but that is what they're trying to do. So I would look for the Chinese yuan to go to maybe from 7.2, maybe 7.5 on its way to 8 sooner than later.
I'll give you some question for investors. Actually, I read your book, UK's book, very interestingly. There may be individuals considering it as part of their investment strategy. What is your recommendation regarding appropriate allocation and strategy for holding gold as a hedge against uncertainties?
Well, I cannot give individual investment advice, and I won't do that. But I'll comment at a macro level that I do recommend institutions and individuals have gold in their portfolios. I think a proper allocation is about 10%. But what's interesting is that when you look at institutional allocations to gold, they're nowhere near that. They're barely 1% on the whole. If gold allocations for institutions went from 1% to 5%, price of gold would go to $5,000 an ounce before you knew it. So I do, from a macro level, recommend that gold be 10% of a healthy portfolio.
How do you think about the another gold, like as digital gold, Bitcoin? What do your take on whether cryptocurrency could eventually take the place of gold?
I don't think that will happen. Cryptocurrencies have no use case. They're like casino chips. They're valuable inside the casino, but if you take them out on the street, you can't buy a cup of coffee. So to me, it's a gambling device. It's a form of entertainment. It's a sort of hallucinogen. People see what they want to see, but it's not money. It's not currency. And I know the price goes up. The dollar price goes up. It's interesting. People say Bitcoin went up. It's like, oh, how much? And they quote you in dollars. They'll say it went from $13,000 to $75,000, which it did. But they still have to refer back to dollars to establish the value. And if you have Bitcoin, you still have to sell it to get dollars to take it out of the system and have any use for it. So it's like a casino chip. You put $1,000 on the roulette table. The croupier gives you chips. You can gamble. You can make money. You can lose money. At the end of the day, when you're done, you take your chips to the cashier and cash them in and get your dollars back. But you're always kind of referring back to a dollar portal. And again, you can make money, but most people have actually lost money. But I don't think they have any use case. I don't see them as a serious rival to gold in terms of a store value.
How do you think about the stock market? The recent stock market is a bit of a slowdown. And do you think it's more a bubble situation, or is there still potential for more growth again?
Well, I'd say both. What I mean by that is I think it is a bubble, but people say you cannot identify bubbles, and that's not true. Bubbles are very easy to identify. The hard part is knowing when the bubble will burst and how much it will go down. That is difficult. So the problem with bubbles is they can last longer than people think, and people is what we call fear of missing out. People just they can't stand it when they go to a cocktail party and their friends tell them how much they've made in the stock market, and they feel like they're on the sidelines. So they go out the next day and buy stocks. So I do believe the stock market's in a bubble. I do believe it will correct severely, but the timing of that is very uncertain. And in the meantime, people are having a good time.
Yeah, thank you. Thank you very much.